All right, welcome to the Whitman Investment Company board meeting on October 15th, 2020. Today we're going to have some board trustees and interns present on financial modeling and how to use the WIC models. So I'll let them take it from here.
Yeah, so today we're going to be presenting what financial models are and a little demo of financial modeling. A financial model, when you boil it down, is a decision-making tool. The objective of financial modeling is to combine accounting, finance, and business metrics to create an abstract representation of a company, usually using Excel, to forecast the future. And basically, that just means we use data to create scenarios to help predict the future. And this could look like estimating the cost and profit of a potential project or anticipating the impact of economic policy change. These are some careers which use financial modeling, which include investment banking and private equity and some treasury business within corporate. Next slide, please. There are many types of financial models, but these are some of the most common ones. But the ones that we'll be focusing on is the discounted cash flow model, which discounts the cash flow so that it's weighted in its present value. But some other notable ones are the three-statement model, which connect the income statement, balance sheet, and cash flow, the merger model, the IPO model, and the LBO model. Next slide, please.
Yeah, I'd also like to note that another popular one and something that we use as well is the dividend discount model.
A little bit about the discounted cash flow model. It's one of the most common ways to value an entire company, and it's using its share of stock. It determines the value of this company by forecasting the company's unlevered cash, discounting it back to today's value. And this unlevered cash is cash generally generated by a business it's the cash that's generated by a business that's available to be distributed amongst its investors. So it's basically the cash that is left over once we pay all current debt and stuff like that. We use cash flow because it represents economic value rather than accounting value. And the reason why we discount it is because of the quote, like, money today is worth more than money tomorrow, which basically references inflation.
Okay, I'm going to run through some of the key definitions, then go into the information that needs to be inputted into your financial model, as well as assumptions you're going to need to make. So first, going over definitions, one of the big ones is the acronym EBITDA, which is earnings before interest, taxes, depreciation, and amortization. Highly connected to that is the EBITDA margin, which is EBITDA divided by revenue. This is kind of like a profit margin, not exactly, but you can think of it in that way. That's a very important number that you're going to need for your particular firm. You're also going to need capital expenditure, CapEx, which is money spent by the firm investing into capital, think machinery, buildings, so forth. Depreciation is that capital's loss of asset value over time. Amortization is the effect of spreading out repayment of a debt's principal and its interest. Depreciation and amortization are usually bundled together as D&A costs. So you'll often see those together in the company's financial statements. Beta refers to the volatility of the stock price relative to something else, usually an index, often the S&P 500. If the beta is above 1, that means the stock price moves at a greater magnitude than the index. If it's below 1, it moves at some fraction of the index movement. Also very important is revenue, which is all cash the company receives from sales and other business operations. So revenue does not include cash the company receives through equity or debt financing. COGS, cost of goods sold, which may include D&A costs in it, And then you can also find gross income by subtracting COGS from revenue. If we go on to the next slide, we see the key inputs that need to go into your financial model and that we're going to be seeing in the demonstration later today. A company's financial reports are going to be broken up into 3 documents, those being the income statement, from which you're going to pull their revenue and EBITDA numbers, their balance sheet, where you're going to pull their assets and their liabilities, and their cash flow statement, where you're going to find capex, dividends, D&A, and then other expenses. Those 3 documents are often listed together. You can find them on Morningstar or MarketWatch. Very, very important standardized documents. You're also going to need your company's particular WACC, or weighted average cost of capital, as well as their current share price and the number of shares outstanding. That's all set, known information that you're just going to be copying and pasting from financial documents or whatever website you're using. If you're clever with programming, you can even set up programs and Excel documents to pull that information automatically. What you can't have them pull automatically is the assumptions, which we see on the next slide. This is where your work as an analyst really comes in. These are figures and numbers that you input that are not copied from anywhere else. These represent what you expect is going to happen in the future. The big one is revenue growth, the percent change in this company's revenue, often broken up over multiple time periods, i.e. next year, the next 5 years, and then terminal. You'll often see a multi-stage growth model of initial very high growth in the near future, declining growth over time, and then a terminal growth rate of revenue at either GDP growth rate or inflation. With all of these assumptions, the garbage in, garbage out principle is at work. The quality of your model and its output is only as good as the work that goes into these assumptions. If your assumptions are not very accurate, your prediction is not going to be very accurate. Some of the other assumptions you're going to need to make is the tax rate that your company will experience in the future, their stock price beta, the growth in their D&A, their future EBITDA margin, as well as the interest rate they're going to be paying on debt. All of those figures are applied to the future, and so when you're conducting your analysis of what you think those will be, looking towards what they currently are and historically have been is a good place to start, but this is where your really important work as an analyst comes in.
Excuse me, I just started talking when I was muted. Lathan, thank you for that. So I'm just going to be continuing about kind of how to build a model, at least more in brevity, until Jake and Mueller are able to kind of take over and show us in a more in-depth way. So kind of the first thing, I guess, at least what I needed, was that you should always familiarize yourself with kind of the ins and outs of the balance sheet, as well as the income statement. All the terms previously described by Lathan, thank you again. And also you should really know Excel or Google Sheets. This will be virtually impossible without the help of that technology. Also, quick shout out, but the current DCF model in the template, if you can kind of maybe look back after this presentation, go through that by yourself, you should be able to at least connect some of the dots and just start to fill in like a little bit more of the picture of what a DCF model is. So essentially, a DCF model is a forecast of a company's unlevered free cash flow, just kind of back to today's value, to get the net present value. And then if you figure out the value of an investment today based on estimated future earnings. So again, a lot of those assumptions, going back to Lathan, they do rely on your future predictions and how accurate those will be, which is why market conditions and maybe changing politics, changing interest rates, all kind of add up in this model. Next slide. So just kind of going over the kind of steps that you'll be taking briefly when building again, this is still a DCF model. So you're going to still forecast your unlevered future cash flows, then calculate terminal value, and from there, discount the cash flows to the present at the weighted average cost of capital, so your WACC. And then you're going to add your non-operating assets to the present values, so that would be such as like property or equipment. And then once you kind of summed all that together, then you're going to subtract the debt of any debt or liabilities. And then from there, you're going to essentially find the share price, and the DCF should give you some sort of picture into the upside based on your predictions and the cash coming into the company, and essentially just give them a standing and then how they should perform down the line. And again, so Lathan already touched on these, but just assumptions to make: the revenue growth and operating margins, the weighted average cost of capital, as well as the long-term growth rate are all subject to change. And without nailing these assumptions, your model will not be as effective as it should be. All right, lastly, didn't take my name off it. But so lastly, just resources for learning more about financial models. Again, just going over it briefly. A book that I found most helpful when learning about the balance sheet was Investica Guru, which is something I read this summer. It was written by the founder of Guru Focus, which is a website that I personally really like to use for financial modeling and analysis. Couldn't recommend this book enough. Obviously, there are a ton of others, but this one really kind of goes through essentially what it means, what a DCF means, and also a little bit more into balance sheet than a lot of other investment books. 2 YouTube videos. I would suggest watching the Money Week one first. It's a little bit briefer. It's about like 10, 11 minutes long. And the Wall Street Prep one, it's a multi-part series, all about 12 minutes long. Both are really helpful. Again, the Money Week's broken down a little bit simpler, and the Wall Street Prep goes a little bit more into depth. And then check out the WIC DCF tutorial video, which is also in templates. All these resources are very useful and all right at your fingertips.
So you can find WIC models under your shared drives in Google Drive, and then you can see the WIC board icon, which is the loaves of bread. And under that, there's a very easy to see folder called current models. And so currently in our portfolio master sheet on Google Sheets, there's a column called target price. And that's just kind of a summation of the valuations that have been created, which you can see on a separate sheet called the valuations page. And those are just created from an average of the DCF, the DDM, and the EPV. We haven't mentioned the EPV yet. It's kind of based on how sustainable future earnings are, how sustainable the current earnings are supposed to be in the future. And so you can see the upside and downside are sort of a comparison of the current price to the estimated target price valuation.
Great, and also just wanted to mention that you can also find the DCF template, DDM template in the general drive, or if you're not a board trustee. You just go to the general drive and you can find that in resources as well. And please let us know if you ever would like an updated copy.
All right, so now that we've talked about kind of the initial setup and kind of just general education material of models, me and Moeller are going to walk through a demo and just kind of see what kind of things we need to input and why. So I'm going to stop sharing my screen. I'm going to let Moeller take the reins here a little bit, and we'll both walk through it.
Okay. Let's see. On this one, but I just should be this one.
Oh, was that the night you faced?
Yeah, so basically like Jake and I am going to like running a demo model pretty quickly here. So basically the company that we are going to analyze today is Microsoft. So the ticker should be MSFT, and it's a quite stable company, and we are going to analyze its cash flow and dividend payment today. So for the model here, first you can just type the ticker of the Microsoft, which is MSFT here, and then it will show you the whole company name and its current price here. So after doing that, we can start our analysis. So I'm going to talk about it from the top to the bottom. So here, the first one is to choose um, type of the company that which kind of like describe what the type of stocks that your target company is. So there are like three kind of different types of stocks here. So basically the first is the growth stock, which stands for the company that is anticipated to grow at a rate significantly above the average growth for the market. So generally, this company pays lower dividend since issuers of such kind of like companies are usually want their earnings to be invested so that they can just accelerate their growth of their company in the short term. And the second one is value stock, which is a stock trading at a lower price than what the company's performance may otherwise indicate. So usually this kind of like company pays like relatively higher dividend, and the blend type of stock is kind of like stand as a middleman between the growth and value. So the company type will just influence the price target that we are going to analyze here. So from here we can see that if the type of stock that you are going to analyze is growth stock, we will weigh like 15% of our DDM and 85% of our DCF, because really this company pays relatively lower dividend. And if the company type is blend, we will weigh about like 30% for our DDM and 70% for our DCF. And if the company is kind of like the growth stock, no, is a value stock, we will average like 50% for the DDM and 50% for the DCF. So from here, I will just talk about like how we can find the company type here. So if you click on Google and search on Morningstar, oops, yes, and type the ticker of the target company that you want to analyze here. So here it should be MSFT, Microsoft. And and I think if you click on the competitors here button here, it takes a few minutes. Try to refresh. So if you click on like show more about the competitive data, so here is Microsoft. It will give you some information about like the type of the company that Microsoft belongs to. So here you can see that the large here means that the market capitalization of the company is relatively large compared to other companies sold in the market. And also it tells you the style of the stock of the company, which is a growth stock here. So back to the model, I just click for the growth here. So then I'm going to talk about like the full year revenue. So basically for the full year revenue just stands for the total sale of the company. So basically we can find it on MarketWatch or Morningstar. I think here I'm going to show you how to find that on MarketWatch here. If you go to the MarketWatch and type the ticker of the company that you want to analyze, here is Microsoft, and scroll down and click on the financial here button here, which can give you like the whole financial statement of the company. So here we can see that it has a income statement, balance sheet, and cash flow statement. So I will just so for the revenue here, I will choose latest revenue that Microsoft has in its recent fiscal quarter, which is 143.02 billion. So here we want to like transfer the units from the $1 billion into the $1 million. So make sure that in your following analysis, you will need to like keep the units consistent. So here it should be like, so the full year revenue here should be like 14,320 for the full year revenue of the Microsoft.
Okay, yeah. So then working into our revenue growth here. So as Trevor noted in the slideshow, a lot of this comes down to your work as an analyst. So where it says here, enter current year expected revenue growth, a lot of things you can do to look for this is you can use Yahoo, you can look at Morningstar, you can look at MarketWatch, you can kind of look at their past performance and kind of determine what their expected revenue growth is this year. The other thing is you can listen to earnings reports or check out the investor relations page of the given website. I like to use Yahoo as my favorite, but for these, I know that for this current year, Microsoft is expecting 9.5% revenue growth. And this next one here, enter revenue growth for the next 2 to 5 years. This is again like where your analyst ability comes in. You kind of have to, from your knowledge of the company, estimate what you think they're going to grow at for the next 5 years. A lot of times, if you go on Morningstar, the analysts will actually give you their opinion on what this value should be. And you can either agree with it, go on the upside or the downside. I believe Morningstar actually projects Microsoft to grow about 11% over the next 5 years. I don't think they're actually going to meet those expectations. I think they're going to be more around the 9% level. I think they're really overestimating the growth of Azure, despite the growth of the company or the growth of that sector actually decelerating quite quickly. So I'm going to set the next 5 years at 9% growth, and then we can move on to tax rate.
Yeah, so about the tax rate, so basically you can also find this one on the Morningstar. So if you go to the main page of the company that you want to analyze, you click on the key ratios here and you click on the full key ratios data. And so here it will give you some information about like the tax rate that the company had in its past like about 10 years, I believe. So here we are going to use the tax rate which is on the reported on its latest like annual report, so which is 16.51 here.
Yeah, an effective tax rate is another thing where you can kind of evaluate your own. Like as he was saying, you can use the past data and use that. Since we are looking at forecasting stuff out, I do personally like to use the effective tax rate of what the corporate tax rate is, which currently is 25%. But again, like so many assumptions go in, so many different changes you can make. So it just kind of depends on what your view is.
Yeah, exactly. Cool. So go to the next one. It's current assets, current liabilities. So basically we need the current assets and the current liabilities to help us calculate the change in working capital. So basically the formula for working capital is current assets minus current liabilities. And for the change in working capital, we want to use this year's working capital minus the past year's working capital. So for the current assets, we can also find this one on the MarketWatch. So if you click on the balance sheet button here and scroll down to the Okay, so here, so go to the assets one. So here it can give you the data of its total current assets in its 2020 fiscal year. So from here we will take the 181.92 billion, but in our model we want to make sure that the unit here is consistent with the unit which we put in our full year revenue. So here we are going to transfer the unit from the $1 billion into the $1 million, which is times 1,000 on this value here. Which is okay. So for the last year data, we can also find this one on MarketWatch, which is 175.55 billion. So which is 175,550 million here. So for the current liability stuff, you can also find this one on the same page. So you can find this one in the liabilities and the shareholders equity page. So it has total current liabilities for the 2020 is 72.31 billion. Which we need to transfer the billion into the million here. So for 2019 fiscal year, it should be 69.42 billion, which is no. Yeah, and then since we have set up our formula here, so the system will automatically calculate the change in working capital for you there. And go to the next one. It's the capital expenditure, which is kind of like as Layson just mentioned, it is a net amount of money that the company will put back into the firm to support its further business growth. So we can also find this one on the MarketWatch. In MarketWatch. So if we click on the cash flow statement button here, and here so in the investing activities, it will give you the data of the capital expenditures. So we make sure, because here it has a preempsis because it's in the negative value here. So in our model, we need to make sure that it should be transferred into the positive value. So also make sure that you should transfer the $1 billion into the $1 million when you input this value in your model. So here it should be $15,440 million. So next one is research and development expense. So basically, like every company has its own research and development expense. So some companies may not listed it into their financial statement, but it does not mean that they do not have their research and development expense. It means that they might include their research and development expense in their capital expenditures. If you meet such situation, you can just type 0 in the research and development item here, black box here. But I believe for some tech companies like Microsoft, it will list their research and development expense in their income statement and the cash flow statement. So I will just choose to find the data in the income statement here. So from here, Research and development. Yeah, so from here we can see that under the SG&A expense, we can see that it has a research and development expense. So from here, I would take the number here, which is $19.27 billion. So go to the next slide. Next one is 1 year depreciation and amortization expense of the company here. So basically it stands for the non-cash expenses in terms of tangible and intangible assets of a company. So basically also you can find it in both the income statement and the cash flow statement here. So I will just choose it will be the same value in both income statement and the cash flow statement. So from here I will just choose the data in the income statement, which is $12.3 billion for 2020.
All right, I'm gonna just walk through these next stats here, which are actually calculated for you, so you don't really have to do these, but just explain what they mean. So I'm gonna start with capital sales ratio. So what this is basically just looking at the portion of sales that is attributed to capital, and how you do that is basically just adding changes in working capital and capital expenditures, and then you divide that by sales and you get 13%, which basically means that 13% of their revenue is being attributed to added capital. And we basically just have this percentage here in order to forecast capital into the future, just because we don't really have a capital schedule from the company. So it's kind of something that we have to extrapolate ourselves. And then working into depreciation and amortization growth, you can see here around 10%. The way I calculate this, just because again, like something that we can't really get on our own, is something like an assumption we kind of have to make that depreciation and amortization is going to increase into the future. And I calculate this by calculating the growth in capital put back into the business. So we expect that Microsoft is going to increase their capital spending at about 10% over the next 10 years. So that is how I increase D&A. So now I'm going to move into the EBITDA margin, which again is earnings before interest, taxes, depreciation, and amortization. You can find this very easily, honestly, by just looking up the company and looking up EBITDA margin. And you should find numerous websites that have charts, graphs, tables, etc., giving you this data. So I looked up the data before this, and I know that Microsoft's EBITDA margin is 46%. And for future year EBITDA margin, this is again something where your analyst skills come into play. You kind of have to give your estimate on what you think their EBITDA margin is going to be 5 or 10 years from now. So, for example, so you can read 10Ks, you can listen to earnings reports, and kind of get an idea of where their business is going. So for Microsoft specifically, I know that they have two businesses. They have their Office side where they have Microsoft Office and Office 365, which is a very stable business. It's a very good cash cow for the company. But at the same time, it doesn't really return high grossing margins. However, they do have their cloud computing business, which is very strong. It has margins upward of 60%. Currently makes up about 45% of their total revenue. And I think it's expected to push over 50, even into like 60% of their revenue in the next 2 to 5 years. So extrapolating from that, I believe that their future year EBITDA margin is actually going to increase about 4 or 5% to 50%. And now we can kind of move into the debt and cash sector.
Okay, yeah. So moving on to the debt and cash sector. So for the cash and cash equivalents here, so basically you can find it on Morningstar. So I believe if you click on the financial button here, and if you scroll down to the balance sheet and it will give you the data for the cash and cash equivalents in $1 billion. So here I will take the data for the 2020 fiscal year, which is $136.53 billion. And also make sure you need to transfer the unit from $1 billion to $1 million here. And also for the total debt, you can also find it on the Morningstar. So go back to the financials balance sheet, and it will give you something about like its total debt, which is $71 billion for 2020 fiscal years. So yeah.
All right, and what we see here is we have normalized interest expense. So the reason why I normalize interest expense is because debt is something that's ever changing. So interest expense from this year isn't necessarily what it's going to be next year or the year after that. So what I've done here is basically just taken a normalized value by looking at the current corporate interest rate structure. And for Microsoft, it's about like 4 to 5%. So that's where you get that normalized value from total debt. So now moving on, that's something that's calculated for you also, by the way, so you don't really need to worry about that. That'll take care of itself. Now moving into the dividend. So like we were saying, so while we're also running a DCF, we're also doing a dividend discount model. So this will help if you do want to do a dividend discount model, you would go click in and you would click yes, which is the Y rather than the no, because if you put the no, then it's not going to factor in the dividend. So we're going to put yes. And here it says enter payout ratio. So what you're going to do is, like Mueller has done before, you can go into Morningstar, or you can even just look it up on Google. Just look up Microsoft payout ratio, and you'll find that their payout ratio, yeah, if you want to show them where that is over in dividends.
Yeah.
It's over on the right. Oh, it might be over here too.
So is that on the, no.
It's under the dividends tab on the top.
Yeah. Okay. Yeah, because usually I like to use one in Yahoo Finance. Also, you can find it on the Morningstar. Here, I think the current payout ratio should be 34.55.
Yeah, 34. And again, another statistic that this will calculate for you is stable state payout ratio. So you see here is 71%. The way I calculate this is by assuming that in the perpetuity, the company will either pay all of its cash out in dividends or be reinvesting that back into the company. So you basically just take that by subtracting 100% minus whatever the percentage of capital to sales is in the future. So 71%, that means that we're expecting about 29% of the cash in future years to be redistributed into capital, which means that we then have 71% left to pay out in dividends. And that'll go into the assumption of the model. Again, something that is already calculated for you, so you don't need to worry about it. But we're gonna move now into some inputs for WACC.
Yeah, so going next to some inputs for WACC, we have like beta and the number of shares here. So I think I'm going to do the beta first. So for the betas, I think you have two ways. So first, you can find the beta on those analysis website. So for example, you can find it on the Yahoo Finance. So if you type the ticker of the company, which is MSFT here, you can find the beta calculated by Yahoo Finance. I think it's on the 5-year months, based on the 5-year monthly basis, which is 0.92. But I think I'm not going to use it here because I think maybe I'm going to like tell how to calculate the beta manually based on its the company's historical data and the S&P 500 historical data. So basically, we know that the beta is kind of like measure which measures the level of the sensitivity of the company's rate of return to the overall market rate of return here. So here for the overall market rate of return, I will choose the rate of return of the S&P 500 here. So here I will just for the Microsoft, if you click on the historical data button, and I'm going to calculate the beta based on its 10-year daily adjusted close data. So click on the time period here and select the start date. I think should be 10 years before, should be maybe 2010. No, it should be 2011. Sorry about that. Okay, and then apply all this stuff, and then click on the download. And you can see there is a so can you guys see my screen share of the Excel file that I just downloaded from Yahoo Finance here?
I don't see it right now. No, I just see
Okay. Sorry. I will just stop share and pull up this one really quick. So can you guys see that right now?
Yes, we can see it.
Okay, cool. Yeah. So from here, it's basically it's 10-year data from the same date back to 2011 to the current date right now. So from here, we want to calculate the rate of return, daily rate of return of Microsoft. I will just so which is the like the adjusted close price of the present day, like divided by the adjusted close price of the previous day and -1. So basically, we want to apply this formula to the whole data of the date here. So you can just use a simple function, which is like to scroll, like there is a, if you click on like the move your mouse to the right corner of the box here, you can see that it will turn into a small cross, and you can just copy paste the whole formula that you applied in this one. So, and then I will try to download the data of so can you guys see my screen share here? No? Or yes?
I can see the Excel sheet. Are you talking about something else or?
Yeah, I think I'm talking about something else. Damn.
Okay, no, I just see the Excel sheet.
Okay, cool. I will just stop share and pull up it. So here it will show back to the Yahoo Finance, and you type the like the ticker of the S&P 500, which stands for GSPC here, and you click on the historical data here, and you choose the same time period as you did for the Microsoft. So for the Microsoft, we did from like 2011 back to 2011. So also you need to choose the date back to 2011. Okay, so then click down, click apply, and then download. Yeah, download the data, and so yeah, we'll just stop share and share this one really quick. So from here, it will give you the data of the daily data of the S&P 500 from 2011 today and to like the 2020. So from here we'll just copy paste the whole just close data to the Excel file that we are going to. I will just share it really quickly. Yeah, so I just copy pasted I just did close data of the S&P 500 to like the I just close data of like Microsoft here. So from here we want to like also calculate the rate of return of S&P 500. So which is this one divided by this one and -1, and just scroll this one down to the bottom. Just copy paste the formula to apply it to the bottom. Yeah, which will give you the daily rate of return. So then what we want to do is to calculate the beta here. So basically the data for the beta part is just like the slope between the rate of return of the SM, like the Microsoft, the target company that you want to analyze. So here it should be Microsoft, and the market rate of return. So here I use the data of S&P 500. So from here we can just use a function of slope. And so from here the y should be the rate of return of your target company, which should be Microsoft. No. And your x should be the rate of return that you have done for S&P 500. So yeah, and then you can calculate the beta based on the 10-year daily data of both the target company that you want to analyze and the S&P 500. So the beta I got here is 1.148. So I will just copy paste this one. I will just use this data back to the and input this one back to the model that we are using. So from here I will just say 1.148 here, and then for the total number of shares, I think basically you can find it on the Yahoo Finance. No, you just type the ticker of the target company you want to analyze. So for here it should be MSFT. If you click on the I think should be under stats tab. Yeah, so from here we can see it gives you the stats of the total shares outstanding, which is 7.57 billions. So for here, we need to transfer the billions into the millions, which is 74570, which stands for the total number of shares. And then I think Jake will talk about how you can calculate the WACC based on the data you know.
Yeah, so as you can see there, the WACC is 8.67. That's something that is auto calculated for you in the WACC tab below in the model. As you can see, it's the fourth tab there. Very complex formula, so I don't recommend you. I mean, you don't need to calculate it on yourself because it does calculate for yourself. But basically what it is basically the rate that a company is expected to pay on average to all of its security holders, whether that be shareholders of stock or that of debt. So the higher the risk of the company, the higher expected WACC. So we see here Microsoft, which is a blend/growth company, we do see a pretty high WACC of 8.67. This value could be anywhere really between 3% and like 13% for really high growth companies. So if you see Microsoft, you're kind of in the middle, a little bit on the higher side, but definitely not out of the ordinary. And then moving above, if you want to move up to the top, we have finished our model. So we can see with Tide's assumptions, along with my assumptions here, we do see that Microsoft has 32.65% upside, which warrants a buy rating. Some other things that we have included here below it, just some financial stuff that I kind of like to look at, which is current ratio and acid test ratio. So the current ratio is just current assets over current liabilities. At 2.5 is pretty strong. And then the acid test ratio, which is basically cash and cash equivalents over total or current liabilities, which basically just shows the company's ability to pay off their current liabilities with the cash that they have on hand. As you can see both by the green cells that both of these statistics are pretty strong, which warrants a financial health rating of great by my standards, at least. Some people might disagree, but I do believe that those metrics are pretty strong. And just here, Muller, just to give them an idea of like what the model looks like, if you want to click on the DCF tab.
Okay.
So this is kind of what it looks like. So you can see here, we forecasted now with those assumptions, we've forecasted their, basically what is their income statement and cash flow statement for the next 10-ish years, which is basically a pretty interesting thing to do. It's actually something very similar to what you might be doing if you're interested in iBanking or if you're doing some kind of acquisition type modeling, something that they would do like this so that you can give like an ideal cost that you would buy a company at, I guess, per se. So something super cool, very useful tool, not only in financial analysis, but also for numerous different industries in the financial world. And if you go to the DDM, you can kind of see this does exactly the same thing, which is basically just forecasting the earnings based off that last sheet for the next, I think that's 15 years. And then deriving the dividends based off the payout ratio assumptions that we've put in there. And then taking into account the dividends and the perpetuity and adding them all together. And we get a value there of, I think it says 2, I can't read it, but it says, well, around 260, I think is what it says. But yeah. Does anyone have any questions on the board? For me personally, just like, so if I was to change assumptions, just because I personally don't think Microsoft has 33% upside at the moment, I would actually label Microsoft as a blend company more so than a growth company. So you can kind of see what happens if you change that. Kind of lowers the downside because what the growth cell does is basically it discounts the WACC into the future versus a blend, which keeps it about pretty constant. Which basically just says that, so for a growth company that might have a WACC right now of 13%, their WACC in 10 years is probably not going to be 13%. It might be like something like 10 or 8. So what the model takes into account is it does lower that value over the coming years. With a blend company, it does keep it a little more constant. So we do see that the price target goes down as we keep that WACC a little bit higher. It also is interesting to know, like, again, like so many assumptions can be put into this, which is kind of where your analytical skills come in. Another thing with Microsoft this year is that they actually said that they're going to decrease capital spending. So that value there of $15 billion in CAPEX is actually pretty low for them. I think it's actually lower than what they've spent in CAPEX over the last 2 or 3 years. So another thing you can do is if you see that and you know that, you can actually increase that value just to keep it more constant with what it may be in the future years compared to what like an outlier year like this year might give them. And again, like, so this model can be found in the Wick Drive. So go ahead, if you go in, make sure you make a copy before you run your own models, but I encourage you guys to do that. And if you have any questions with your model, if you're getting really weird numbers, feel free to reach out and we can kind of help walk you through it if you'd like.
Great. Thank you so much, Jake. And thanks for everyone who presented on financial modeling today and how to do it through the Whitman Investment Company. Thanks for coming today. Thanks for watching this video. If you're checking it out, if you have any questions, feel free to reach out to anyone on the board for tips or info on how to do this and how to make more accurate models. And that's all. Thank you.